Hello, everyone. This is Ted Bauman here, editor of the Bauman Letter. I'm here with Clint Lee. As always on Monday, Your Money Matters. Today, we're going to talk about the future. We're going to talk about where things are likely to go in the post-crisis phase. Something I touched on Friday, but we're going to talk about it a bit more, get Clint's views on the same topics, maybe look in detail into some of the opportunities that are there. But before we do, just to revisit where we've been predicting that there's going to be a slowdown in the rate of growth of stocks and then a decline down to retesting the previous lows we had in March, so-called double bottom. Some people have pushed back. They've said you can't fight the Fed. Stocks will continue to go up. But now this day that we're recording this on Friday, we're starting to see something different. We saw a pullback in the market in reaction to things like the unemployment figures, the GDP figures, just as I predicted. I said when those numbers come out, people are going to panic. They should have anticipated this, but they didn't for some reason. And remember, this is only the first quarter. The second quarter is still to come. That means that when those numbers come out, we really are going to see whether the stock market can continue on its mission of faith rather than substance. And on that score, I just want to show something that illustrates my point about the Fed before we start our conversation. Here's a chart that shows the major bond ETF that covers both corporate, mainly corporate bonds, and it effectively shows two things. One is that the yields on those particular markets were up. The corporate debt markets were rising until March, at which point they collapsed. Now, at the very bottom, in mid-March, what happened? The Fed announced that they would backstop corporate lending. Now, here's the interesting thing. The Fed hasn't actually bought any bond markets. It hasn't bought any corporate bonds yet. It hasn't bought any ETFs. But look at what's happened to the market. It's back up to roughly where it was in March, which is actually higher than it was at the beginning of the year. Now, remember, folks, that's all based on faith. That is based on the idea that the Fed will rescue bond markets. And we argue the same thing about the stock market, that the Fed is basically in a position where it's creating faith on the part of investors. And faith is not a good way to invest. You want to invest based on facts. So, Clint, what are some of the facts? We've made some predictions about stocks and about sectors in the last week, and over previous weeks, we've talked about a lot of them. You have a chart you want to show us, walk us through it and tell us about the various predictions we've made and who's doing well and who's not.
Yeah, sure, Ted. So the chart we're showing here, this is going to look at the S&P relative to various sectors over the last 4 weeks. This is going to capture most of the month of April. Look, April was a terrific month for the markets. I think it was the best month since 1987. S&P overall up about 13%. Rallying on that sort of faith that you've talked about. But when you look underneath the hood, some of the sectors that we've been highlighting, that we've been recommending in some of our commentaries here recently and in these videos have done particularly well. I know one sector you've talked about a lot has been the housing sector. XHB on here up a little over 40%. So I'm going to glance at my notes. I know online retail stores is another one that we've been highlighting here recently, up about 35% or so. Biotech, another sector with strong performance, up about 25%. Then we've also seen an ETF called Robo. That plays into the industrial automation theme that you've been hitting on recently. And then also CLOU is a cloud computing ETF that we've discussed as well, that could all be seeing benefits from some of the underlying trends that have come out as a result of the pandemic.
So basically, we're 100% for our predictions, at least over the last month. Now, the important thing to remember is that when these sectors outperform the market, it means that investors recognize potential in them that is uncommon. It's potential that is greater than the potential of the rest of the market. Now, the market itself, we know, has been driven largely by large cap technology firms. I think right now, 20% of the value of the S&P 500 is just four big technology firms. So these are firms in these smaller sectors that are outperforming them. And our thesis here is that they're outperforming because they reflect investor sentiment about where things are going in the long term, not just in the short term, but in the long term. Online sales, robotics, eventually the housing market's going to recover, biotechnology, et cetera. Clint, what else do we need to be thinking about in the future? One of the biggest thing that I worry about sometimes is what about the sectors that are going to disappear, that are going to really suffer? Well, do you see any in particular that you think may not actually survive this, or at least not in the current form?
Yeah, so I guess, one of the antithesis to one of the ETFs we talked about, which is the online Stores ETF. Look, we've been seeing sort of this change in consumer behavior, not just come about because of the pandemic, but it's been ongoing for years now, for the last decade. When you look at retail sales overall, it's about a $5.5 trillion industry. There's still, despite all the attention that Amazon gets out there, they're not the only retail game in town. It's still a small slice of the total pie goes to online sales. Online sales are only about 11% or so of the industry right now. But like I said, that's a number that's been increasing steadily over time. And I think this pandemic is going to only accelerate sort of the change in consumer attitudes that's already been occurring. I know that I can speak to that within my household. We've definitely ramped up our online purchases, and we don't feel comfortable, even though some states are starting to return back to normal. We don't feel comfortable going out to brick and mortar anytime soon. So that's one where I think, where you see the one sector starting to benefit more so, and that's taking away from the brick and mortar retail, who has been in the headlines pretty prominently with some of the struggles here recently.
Yeah, now is not a good time to be invested in a retail company. Also, if you own real estate investment trusts in the retail and mall sectors, boy, they're getting hammered hard. But that's interesting that there are some REITs that are doing extremely well. And in fact, that's going to be a topic for one of our upcoming Bauman Letter reports, which I think is an important consideration. Real estate has different flavors, and some of them are doing well. Well, one of the things that interests me is all this talk about onshoring or reshoring, or kind of trying to de-globalize the economy to try to protect not just the U.S. ability to produce essential goods like medicines and chemicals and protective gear, but also just the vulnerability that companies realize they have now when their suppliers in places like China are unable to deliver. And I just want to add to one of our predictions and say that I see the potential for growth in a lot of companies that are involved in industrial supply, companies that produce the kinds of things that companies, or that industrial companies need when they reopen plants, when they open new plants. So, for example, a company like Rollins, for example, which makes a lot of things that go into the everyday operations of a factory. Those companies could do very well in anticipation of reshoring, if you like, of production. But let's talk now about just the overall financial system. We've talked a lot about the Fed, because everybody says you can't fight it. But how would you characterize what the Fed is doing right now in terms of, just the relationship to the real economy? I mean, how do we understand the relationship between what the Fed's doing and what's actually happening in the real economy?
I think you said it earlier. I mean, it's all about just trying to restore confidence. It's just the sort of that threat, if you will, of them coming in to scoop up assets is maybe, helping keep some of the other challenges at bay. The absence of buyers for whether it's corporate debt or junk debt kind of reminds me of my kids when they're not behaving. I threaten to take away the iPads, even though I haven't done anything. I see an instant change in behavior that tends to go my way. And I think that's kind of what the Fed's doing. They're stepping in and trying to provide some sort of confidence, because look, these companies need money right now. I mean, they're tapping the debt markets because they need to raise funds, because they're seeing this impact of their financials. They're seeing this impact of sales, but they still have to fund operations. They still got to pay employees that they've kept on the payrolls, and they need to hit the debt markets to do that. And they need investors to want to step in and buy their debt at a reasonable interest rate.
Well, and this is something we were talking about before we started recording. I made the comment that debt markets are kind of like Wile E. Coyote walking off the edge of the cliff into, and he keeps walking on thin air, and then eventually, boof. That's kind of the way I look at this. I think, right now, the way I see it is that we have the Federal Reserve, which has essentially made a commitment, not in so many words, but it has clearly sent this commitment out to the whole world that it's going to prop up asset markets. It's going to prop up the value of commercial bonds. It's going to prop up the value of stocks. and it's going to do whatever it takes to do that. By contrast, the real economy is really dependent on Congress and on the mechanisms of the federal government to keep the economy going. And as we know, that's not going well at all. And that's what I think when I say that Wile E. Coyote walks out on the thin air. It's that thin air. That's the real economy. It's where the Small Business Administration is not getting loans out. People are being confronted with the choice of either going back to work in a dangerous situation or losing their unemployment benefits, all kinds of things that just don't make sense in terms of everyday reality. And eventually, I think that's going to lead to a disjuncture where investors are going to say, if it's just the Fed without the real economy, then, well, at the end of the day, what kind of dollar buy? If the economy is not in good shape, what can it do? But let's go back to the question of the real economy. I mean, you spoke about retail as potentially being under threat. Do you see any other sectors or any particular niche opportunities in the sectors that we've identified that have potential great investment opportunities as we come out of this?
Yeah, so one that I mentioned a couple weeks ago, and actually this plays into one of the themes that I know you're talking about in the video that comes out today on Friday, but it's the cloud computing sector. When you look at earnings releases from some of these big tech firms that have come out, from Amazon to Google to Microsoft, the one consistent theme that you've seen is that their cloud divisions are seeing an uptick in demand, which isn't surprising because as we go through the work remote, learn remote, we're consuming more of our entertainment at home. That's benefiting companies up and down sort of this cloud supply chain. So not only the service providers like Google, like Amazon, like Microsoft, but also the infrastructure providers like the Equinixes or Digital Realties of the world, to the companies that actually then deliver their services and software via cloud-based applications. And that could be anything for entertainment like a Netflix, or something that you might use at home while working remotely like a Workday, an HR type platform.
Well, it's fascinating that you mentioned that, because you may remember last year at our Total Wealth Symposium, where we talked about, or I gave a presentation on cloud computing. And what did I say? I said that in a recession, companies are going to use cloud computing as an opportunity to reduce their headcount. They're going to use it as a way to rationalize their operations, to save money, to try to come out of the next recession in a leaner and more competitive shape than they were. And that's exactly what we're seeing. 40% of industrial, or rather economic managers, the financial managers of big corporations, say that they are looking at increasing automation, looking at increasing the use of software and other types of labor-saving technologies in the midst of this crisis. And we predicted this months and months and months ago, even before anybody had heard of COVID-19. So I think that's an illustration of what we try to do, with the Bauman Daily. We try to look at trends by applying logic to the way that the capitalist industry operates, and try to anticipate the way they will react. And in this case, I think we're getting it right. Lastly, before we go, let's talk a little bit about how the political sphere is likely to influence the investment environment. I've said in my Friday video that I think that there's going to be a demand on the part of ordinary people, voters, that the government become more accountable, that it become more efficient and effective, and be able to do things to protect us from these kind of things. What's that going to do to us? You think taxes are going to have to go up, for example? What's your opinion on that?
Oh, well, I mean, look, we've through various rounds of stimulus. I mean, how many trillions of dollars have we added to the deficit? I mean, we were already running a record deficit in terms of, not seeing a recession before COVID-19, the pandemic, everything hit. We're already pushing $1 trillion on an annual deficit. And then we see, what's been lopped on top of that. How do we pay for all this down the road? I don't know any way around it other than, we do need to see higher taxes. How else is the government going to raise revenue here?
Well, a U.S. senator or congressman, I can't remember which years ago, in the early 1960s, was talking about the federal deficit and spending. And he said, $1 billion here, $1 billion there, and pretty soon you're talking about real money. Now we're talking in trillions. The figure I've heard is that the Western governments have committed to $6 trillion worth of stimulus collectively so far in this crisis. And so, eventually either that money comes from somewhere or we write it off, in which case that has a whole another set of ramifications for the global economy. Anyway, folks, that's our take on where things are going. There's a lot more to it. Just to remind you, you can subscribe to the Bauman Letter here right on the YouTube channel by clicking on the links or the graphics that take you there. And I think now's a good time to do it. We have some really good defensive plays that are actually, I think, going to do extremely well in this environment, coming out of places that you would not expect. That's kind of what we try to do with the Bauman Letter. So if you're interested, please click and do consider subscribing. So Clint, I'll see you next week. This is us for Your Money Matters for this week. Take care. Bye-bye.